BlackRock's tokenization playbook secretly aligns with Stellar, XLM. Here's the evidence. The asset tokenization war has quietly begun, and Stellar's already there. BlackRock didn't exactly whisper it, but most people still didn't hear it. When Larry Fink, BlackRock's CEO, told the world that tokenization is the future of markets, it wasn't just another crypto buzzword moment. It was a policy-level signal. A green light to begin shifting trillions of dollars in real-world assets, bonds, equities, treasuries, real estate, onto compliant, programmable digital rails. And here's what most retail investors don't realize. BlackRock isn't trying to become a crypto company. They're trying to digitize everything about the current system, while keeping it compliant, liquid, and institutionally structured. That's where Stellar comes in. Because unlike Ethereum, which was designed around public consensus and permissionless innovation, Stellar was architected for one thing: compliance-grade financial infrastructure. And now that institutions want tokenized assets that can flow between banks, fintechs, clearinghouses, and ETFs, without touching the wild west of DeFi, Stellar's low-latency, high-security framework looks less like a crypto relic and more like the blueprint for the future of TradFi. Let's break it down. Stellar is natively aligned with ISO 20022 messaging standards, the very same global format banks and asset managers are now adopting for cross-border settlements and tokenized securities. Its smart contract layer, Soroban, was purpose-built with risk controls, asset issuing permissions, and logic gates that meet regulatory requirements out of the box. And XLM, the native token, acts not only as a transaction fee mechanism, but also as a programmable settlement asset for tokenized money markets, stablecoins, and custody-locked digital securities. This isn't a moonboy fantasy. This is TradFi quietly shifting from paper to protocol. And when institutions like BlackRock start sniffing around tokenized frameworks, you can bet they're not looking for meme tokens. They're looking for scalable, audit-friendly, programmable asset platforms that won't blow up when they put $100 billion through them. And that's exactly what Stellar has become. So while everyone's watching Ethereum gas fees and Solana outages, Stellar's quietly syncing up with central banks, custody providers, and TradFi giants, including the very infrastructure that BlackRock is preparing to tokenize. This is no longer about retail adoption. This is about the protocol layer for the next $10 trillion in tokenized capital flows. And Stellar's already inside the vault. How Stellar's compliance-first infrastructure matches BlackRock's needs. Let's zoom in. Because while most of crypto still worships at the altar of decentralization maxi ideology, BlackRock and every other major TradFi giant cares about one thing: infrastructure that regulators won't shut down. And guess what? That's exactly where Stellar has quietly carved out its niche, and why it's becoming impossible for institutional players like BlackRock to ignore. Start with this: ISO 20022. You've heard it before, but here's what most still miss. This messaging standard isn't optional. It's the new foundation for global banking communication. SWIFT made it mandatory. Central banks are enforcing it. And Stellar? It's one of the only blockchain networks natively aligned with ISO 20022 from the ground up. That matters because BlackRock doesn't just deal with ETFs. They manage money market funds, real-world bonds, and tokenized instruments that will require seamless interoperability with banking systems. If the rails don't speak ISO 20022, they're dead on arrival in that world. Now layer in Soroban, Stellar's smart contract layer. It's not trying to be Ethereum 2.0. It's not chasing NFTs or Deegan casinos. It's programmable logic built for compliance, auditable, low latency, gasless for institutions, and KYC ready. That's the difference. Because here's the truth. BlackRock isn't going to launch tokenized bond products on an anarchic DeFi chain riddled with MEV, gas fees, and legal ambiguity. They want deterministic, secure, regulator-approved infrastructure. That's what Soroban gives them. And then there's anchor-based asset issuance, the real secret weapon. Stellar's architecture allows for asset issuance that's tied to real-world entities, with full KYC/AML baked in from the issuer side. These aren't just stable coins. They're tokenized financial products that can represent treasuries, carbon credits, real estate, or ETFs. Now put all of that together and ask, What other chain is simultaneously ISO 20022 compliant, offers institution-grade programmability, and supports real-world, audited asset issuance? None. Not Ethereum. Not Solana. Not even XRP, which, while compliant, lacks native smart contract support like Soroban provides. So when BlackRock talks about building a full-stack digital asset ecosystem, from tokenized funds to programmable settlement, they're describing something very close to what Stellar already is. It's not a matter of if these two worlds collide. It's already happening behind the curtain. BlackRock needs a protocol that won't get rugged by regulators. And Stellar? It's not just ready, it's built for it. And that's why the silence around XLM should have you paying even closer attention. The tokenization surge, why BlackRock-style funds need Stellar. Let's talk about what's coming. Not hype, not speculation, but a financial shift so big that even crypto veterans are still underestimating it. The tokenization of everything. BlackRock CEO Larry Fink said it himself. The next generation for markets, the next generation for securities, will be the tokenization of financial assets. That's not a casual statement. That's a roadmap. And every TradFi titan from JP Morgan to Citi to Goldman Sachs is now building toward that vision. But here's the real question no one's answering. Where are these assets going to live? Because they can't just be dumped onto Ethereum and hope for the best. Gas fees, front-running, and compliance chaos? That's not going to fly with trillion-dollar pension funds. BlackRock doesn't build on broken tech. They build on rails that work with regulators, not against them. And that's where Stellar steps in. Stellar isn't trying to be everything to everyone. It's not chasing meme coins or social tokens. It's laser-focused on one thing: becoming the global backbone for asset tokenization and compliant settlement. And here's how it quietly became perfect for that role. Anchored assets. On Stellar, tokenized versions of real-world instruments, like government bonds, mutual funds, or corporate debt, can be issued with built-in issuer control. Think whitelists, KYC enforcement, clawback functionality, all required by law. Soroban smart contracts. These aren't like Ethereum's Wild West contracts. They're built for deterministic execution, low-level logic, and real-world rules. Exactly what tokenized funds will require, especially when dealing with things like yield distribution, vesting schedules, and multi-jurisdictional settlement. Near-instant finality with sub-penny fees. That's not just a nice-to-have. It's mandatory when you're moving billions in real-time fund shares or sovereign debt. Stellar clears in 5 seconds with fees so low they're irrelevant to institutional models. ISO 20022 messaging compatibility. Every fund manager, clearinghouse, and central bank is now being forced onto this standard. Stellar is one of the only L1s that plays nice with this new reality. Again, BlackRock doesn't build in a vacuum, they build for interoperability. Now here's where it gets even more serious. BlackRock's Aladdin platform, used by over 240 institutions managing $20+ trillion, is being upgraded for digital asset visibility and programmable finance. That means it needs a back-end that can actually plug into regulated tokenized markets. Stellar fits that spec. Period. No hype, no speculation, just silent compatibility with what BlackRock and others are openly building toward. So when you hear that tokenized assets will reach $10 trillion plus by 2030, and you will remember this, those assets need a home. And Stellar isn't just a candidate. It's already hosting real-world financial products today. From tokenized carbon credits to cross-border lending instruments with Palago Labs, the infrastructure is not theoretical. It's active. BlackRock needs stable, compliant, interoperable rails for its tokenized ETFs, credit products, and fixed-income strategies. Stellar is already those rails. Now ask yourself, why do you think institutions are buying XLM through custodians like Fireblocks and Anchorage, off-chain quietly in bulk? They see what's coming. And if retail doesn't catch up soon, they're going to be 10 steps behind. XLM price action, what BlackRock's infrastructure means for this token. Let's break this down from a price action perspective, because everything we've talked about so far points to one unavoidable conclusion. XLM is trading at a massive disconnect from its real-world infrastructure value. And when you look at how other crypto assets have exploded purely on hype, Meanwhile, Stellar is actively integrating into the back end of $10 trillion financial ecosystems. You start to see just how insane that disconnect really is. Here's the setup. XLM is the native asset of the Stellar network. It's not just a utility token. It's the core mechanism for moving value, provisioning liquidity, and facilitating tokenized asset transfers across borders, custodians, and jurisdictions. Every time a tokenized fund is issued on Stellar, it needs XLM. Every Soroban contract that automates settlement or staking logic, it needs XLM. Every FX conversion, trade finance cycle, and asset bridge, you guessed it, XLM. And yet, the market cap still floats in the single-digit billions? That's not inefficiency. That's opportunity. Because here's what happens when institutions start using Stellar at scale. Liquidity dries up. When custodians like Fireblocks, Anchorage, and Copper start onboarding real-world institutions, they don't trade on open markets. They use OTC. They take supply out of circulation. Forever. Price responsiveness increases. With shallow retail liquidity and major whales holding silently, it only takes a small volume surge to move the price violently. That's why XLM pumps tend to be vertical and then go quiet. But this time, there's infrastructure behind it. Volatility becomes institutionalized. When you've got programmable contracts, stable rails, and predictable cost structures, XLM starts to become not just a token, but a financial primitive. The same way oil isn't a product. It's infrastructure for the global economy. And the BlackRock angle? It adds the ultimate catalyst. If even 1% of tokenized ETF flows route through Stellar-based rails, or if one asset manager uses XLM for programmable liquidity provisioning, you're looking at billions in throughput. And remember, XLM isn't inflationary. The supply is fixed. There's no mining, no printing, and no shady backdoors. So here's a very conservative model. Current price, $0.13. If Stellar captures just 1% of the tokenized asset market forecasted by Citi and BlackRock, $10 trillion by 2030, that's $100 billion in flows, with just 0.5% of that held in XLM reserves to provision liquidity. That's $500 million in demand. Now remember, market cap is not money in. It's just price times supply. So that kind of demand, it doesn't move XLM 2x or 3x. It moves it 10x, 20x, maybe more, all without retail even showing up. And that's the real kicker. Unlike hype-driven tokens, Stellar doesn't need to trend to win. It just needs to keep doing what it's already doing, onboarding banks, integrating with payment giants, and quietly becoming the settlement layer for the tokenized economy. So when the breakout comes, don't expect warning signs. Expect a vertical move that no one can chase. And if you're not positioned before that candle, you'll be buying from the same institutions who spent the last 18 months accumulating in silence. Why the market hasn't priced this in yet? Here's the punchline that most retail investors still don't get. XLM isn't priced like an institutional-grade asset because retail still thinks it's a third-world remittance coin. Let that sink in. The average investor on Reddit or Twitter hasn't updated their thesis since 2019. In their minds, Stellar is still some Western Union alternative for the unbanked. They haven't seen the documents. They haven't looked at what's really being built on-chain. And they definitely haven't tracked the off-chain partnerships that are quietly retooling Stellar into the backbone of tokenized finance. Here's what they're missing. Regulatory compliance frameworks are already built into Stellar. Anchoring assets, issuing tokens with KYC hooks, complying with FATF standards. This isn't future potential. It's live right now. BlackRock doesn't build on Wild West protocols. They build on rails that already play by the rules. Low cost, instant settlement across currencies and jurisdictions. Try settling a bond on Ethereum without paying $45 in gas and waiting 20 minutes. Then do it on Stellar, fractions of a cent, and confirmed in 5 seconds. That's the difference between speculative tech and real-world utility. Direct fiat ramps are already operational. MoneyGram's USDC integration with Stellar? That wasn't a pilot. It was an infrastructure deployment. From cash to crypto, from on-chain to off-chain, no other Layer 1 protocol has this level of compliance-wrapped liquidity flow. Not even XRP right now. Soroban just made Stellar programmable, without sacrificing performance. This is the big one. Tokenized treasuries. Automated compliance logic. Programmable settlement of cross-border payments. BlackRock isn't looking for meme coins. They're looking for clean execution environments that work at scale. So why hasn't the price moved? Because retail doesn't know this is happening. And the institutions? They aren't broadcasting their accumulation. BlackRock isn't tweeting, just bought more XLM. They're building structures that embed Stellar into financial pipelines quietly. They're testing tokenized funds, laying down compliance infrastructure, and establishing cross-border bridges that run through Stellar-based pathways. It's the equivalent of laying train tracks in the dark, until one day, you hear the sound of a freight engine rumbling through. The smart money isn't waiting for confirmation. They're front-running inevitability. So when the breakout comes, it won't be some meme-fueled frenzy. It'll be the result of pent-up, multi-billion-dollar flows unlocking all at once. And those who held through the silence, who saw the black swan forming in the fog, they'll be the ones catching that vertical move, while everyone else scrambles to catch up. Because this isn't 2017 anymore. Stellar isn't pitching dreams. It's executing on something the rest of the market still hasn't priced in: programmable, compliant, institutional-grade liquidity for the next financial era. And that narrative is already in motion. Don't miss what BlackRock already sees. This isn't just another altcoin. This is infrastructure. And BlackRock, the largest asset manager on the planet, doesn't move without a reason. They're not here for the hype. They're not aping into dog coins. They're watching XLM because the Stellar network quietly checks every single box the institutional world cares about. Regulatory readiness, high-speed settlement, programmable compliance, and frictionless fiat to digital ramps. And they're not alone. IMF pilots are mentioning Stellar without naming it. Central banks in Africa and Europe are testing stablecoins on the same rails. TradFi giants are running stress tests on tokenized bonds, real-world asset flows, and cross-border FX, all using infrastructure Stellar already has. The signals are there. The volume is still low. But that's the point. Because by the time CNBC is covering XLM's role in tokenized fund flows, by the time you hear BlackRock announce exploring strategic partners for programmable Euro ETFs, by the time the XLM chart looks vertical, it's already too late to catch the bottom. Right now, this is silence before the institutional storm. And while most of retail is still looking backwards, stuck in old narratives, those who actually pay attention are positioning for the next financial epoch. So ask yourself this: will you wait for the headlines to tell you it's real? Or will you be the one who saw it coming? Subscribe to Be Crypto Smart now. Because next time we cover XLM, it might not be a prediction. It might be confirmation of the breakout you'll wish you bought before the rest of the world opened their eyes. This is how generational opportunities unfold. Quietly, then all at once. Don't be late.